In this learning objective, we're going to prepare an analysis showing whether a special order should be accepted or rejected. Special orders are one-time orders that are not considered part of a company's normal ongoing business. When analyzing a special order, only the incremental costs and benefits associated with the order are relevant to our decision. Since the existing fixed manufacturing overhead costs will normally not be affected by a special order, they aren't relevant for part of our analysis. Let's consider an example of a special order. Let's assume Jet Inc. makes a single product whose normal selling price is $20 per unit, and a foreign distributor offers to purchase 3,000 units for $10 per unit. This is a one-time order that will not affect the company's regular business, and annual capacity is 10,000 units, but Jet Inc. is currently only producing and selling 5,000 units, should the special order be accepted. A couple things to notice here. First, in this particular case, for this special order, we have excess capacity. That's important because if we don't have excess capacity, we need to evaluate any loss contribution margin on existing sales that we would incur if we accept the special order. Also, we're told that this is a one-time order and it's not going to affect our regular business. In other words, we won't cannibalize our existing sales. Let's look a little bit closer at the details for this special order. Here's a contribution margin income statement for Jet Inc. Notice we've got $100,000 in sales revenue on sales of 5,000 units, so our selling price is $20 per unit. Our variable costs are $8 per unit. That's our total variable cost of $40,000 divided by 5,000 units. So very quickly, it's clear that if we have a variable cost of $10 per unit and we have an opportunity, a special order for selling these units at $10 a piece, we should probably accept the order as it has a positive contribution margin. We'll increase our revenues by $30,000. That's 3,000 times $10 per unit selling price. And our variable cost will increase by 24,000, leaving us with a $6,000 increase in net income. We could have also arrived at the same number by taking our $2 per unit contribution margin and multiplying it by the 3,000 units. Note, our answer assumes that our fixed costs are unaffected by the order and that our variable marketing cost must still be incurred on the special order. Notice we had variable marketing cost of $5,000. If we didn't need to incur our variable marketing cost, then our cost per unit would only be $7, and this special order would increase our net income by $9,000, or $3 per unit times 3,000 units. If we had any increase in fixed costs, these would need to be deducted from this incremental contribution margin. Let's consider another quick example. Northern Optical ordinarily sells the X lens for $50. It has variable production cost of $10 per lens, and our fixed production cost is $18 per unit. Our variable selling cost is $1 per unit. A customer has requested a special order for 10,000 units of the X lens to be imprinted with the customer's logo. The special order would not involve any selling cost, but Northern Optical would have to purchase a special imprinting machine for $50,000. What is the minimum price that we should not go below in negotiating with our customer? In other words, below what price would Northern Optical actually be losing money on the sale? Again, assume we have ample excess capacity to fill the order and the imprinting machine has no further use after this order. We want to make sure we consider our variable production cost and any additional fixed cost associated with this order and compare it with our incremental revenue. Again, our variable production cost is $10 per unit and the special imprinting machine cost $50,000. The minimum price for the special order then would be $15 per unit. We had variable cost of $10 per unit times 10,000 units, or $100,000. We had $50,000 additional fixed cost, and then we divide that total relevant cost of $150,000 by 10,000 units, and we get an average cost per unit of $15. Above this, we increase our profits below a $15 price, we would decrease our net operating income. Let's consider another example. Imperial Jewelers is considering a special order for 20 handcrafted gold bracelets to be given as gifts to members of a wedding party. The normal selling price of a gold bracelet is $189.95, and its unit product cost is $149 as shown below. Notice we've got $84 in direct material cost, $45 for direct labor, and our manufacturing overhead is $20 per unit. But most of the manufacturing overhead is fixed and unaffected by variations in how much jewelry is produced in any given period. However, $4 of the overhead is variable with respect to the number of bracelets produced. The customer who is interested in the special bracelet would like a special filigree applied to the bracelets. This filigree would require additional materials costing $2 per bracelet and would also require the acquisition of a special tool costing $500 that would have no other use once the special order is completed. This order would have no effect on the company's regular sales and could be filled using the company's existing capacity without affecting any other orders. What effect would accepting this order have on the company's net operating income if a special price of $159.95 per bracelet is offered for this order? Should the special order be accepted at this price? Let's go ahead and compare our incremental revenue per unit with our variable cost per unit. Our variable cost per unit is $135. What we need to be sure of is our contribution margin per unit times 20 bracelets is enough to cover the cost of the special tool. Let's go ahead and find our incremental revenues in total. That's going to be $3,199. That's 20 bracelets times $159.95 a piece. Our direct material cost will be 20 bracelets times $84 a piece, or $1,680. Direct labor cost will be $900. Our variable manufacturing overhead cost will be $80, and our cost of the special materials for the filigree will be $40. In total, our variable cost will be $2,700. Once we add to this the cost of the special tool, our incremental cost will be $3,200, which unfortunately is greater than our incremental revenues of $3,199. At a price of $159.95, we should not accept the special order.